Welcome, dear students, to the massive open online course on money and financial markets. In today's module, we are going to learn about the meaning and process of financial development. In this module, we would like to explore the channels of interaction between finance and growth. We would also explore the functions that a financial system is expected to perform. We would try to understand how financial development affects the savings rate. And lastly, in this module, we are going to also try to find out the various measures by which financial development of an economy can be measured. Now, the correlation between financial development and economic growth is under constant examination by economists and policymakers alike. In particular, there continues to be considerable debate over the causal link between the two. The literature on this subject is naturally closely linked to that on endogeneity in economic growth. We would first like to look at the channels of interaction between finance and growth. In broad terms, there are basically three camps who have different vision about the interaction between finance and growth. The first proposes that financial evolution basically depends on real growth, with the range of financial instruments and institutions responding to needs as they arise. The second position suggests that financial development precedes economic growth, encourages economic activity by offering new products and initiatives. Schumpeter regarded finance as being one of the two key elements. Gurley and Shaw emphasized the importance of the role of finance in growth. Goldsmith came close to asserting that financial systems actively promoted real growth, and Gerschenkron considered that finance played a key role in the process of development, particularly from countries of relatively backward situation. So we can say that financial development and growth has been a crucial subject of public policy for quite a long period of time. As early as in the 19th century, a number of economists stressed the importance of financial development for the growth of an economy. The banking system was recognized to have important ramifications for the level and growth rate of national income via the identification and funding of productive investments. This in turn was expected to induce a more efficient allocation of capital and foster growth in turn. While a contrary view also prevailed at the same time, suggesting that economic growth would create demand for financial services. This meant that financial development would follow growth more or less automatically. In other words, financial development could be considered as a byproduct of economic development. But we are still left with the third view. The third view is that finance and real activity accompany each other in a simultaneous way, each responding to signals from each other. But there is some argument to be made that the relative importance of finance shows or grows as GDP rises. As Wyand Patrick wrote, in general, financial development proceeds concomitantly with economic development, with finance playing an increasingly important role. Next, we go to the next part that we have in the objectives, that is, what are the functions that a financial system is expected to perform. Number one, in the presence of information asymmetrics, financial markets could still develop in order to facilitate trading and hedging of risks. Risk mitigation and economizing on information acquisition and processing reduces the uncertainty and enable resources to flow towards more profitable ventures. Such a situation would raise the efficiency of investment and the rate of growth. Secondly, by acting as an efficient conduit for allocating resources, the financial system enables an improvement in technical progress. Technological innovations take place when entrepreneurs exploit the best chances of successfully initiating technologies in their production processes and introducing new products. Over time, as skills develop and as the economy experiments with adaptations of the existing technologies and creates a base for research and development of new technologies, growth rates are likely to move upward. This is particularly valid in financial systems that are more effective in pooling the savings resources of individuals and permitting continuous upgradation of technologies for promoting growth on a sustained basis. And finally, to the extent that financial development leads to the creation of financial infrastructure and enables better and more efficient provision of goods and services, costs of transactions would be lower with positive spillover on economic growth. However, the recent growth literature builds on the learning by doing processes, assigns a special role to finance. Finance is seen as a crucial factor of production, like knowledge, and the influence of institutional arrangements in regard to finance on growth rates has often been forcefully emphasized. These models offer important insights on the impact of financial development on economic growth. Next, I would like to touch upon the endogenous growth model and financial development. Now, as I've already said, that the linkage between finance and economic development has been resurrected over the past decade by the endogenous growth theory, which is very important in economics. The new growth models trace the steady state growth rate, which we call small g, in terms of three crucial parameters, namely the level of technology, which is captured by the social marginal productivity of capital, which we call capital A, the proportion of the savings channeled to investment, which we call small f, and of course the savings rate, which we call small s. If we ignore depreciation, the new theory seeks to establish that basically G, that is a steady state rate of growth, is equal to A into F into S. So, financial development could influence economic growth by increasing the productivity of capital or by lowering of intermediation costs via an increase in F, that is the proportion of savings that has been channeled to investment, or by enhancing the savings rate, that is small s. An efficient financial system basically allocates funds to projects with the highest marginal product of capital, and thereby it helps in fostering economic growth. This phenomenon could also be seen from a different angle. Individuals faces uncertainty about their future liquidity needs, and therefore they need to invest either in a safe, low productive liquid asset or in a risky, high return illiquid asset. In such a setup, financial intermediaries allows individuals to reduce risks associated with their liquidity needs and channel savings into activities with high productivity. The next point that we had in our objective is how financial development can affect the savings rate of an economy. Now, we know that this involves idiosyncratic risks, rate of return risks, interest rates, and liquidity constraints. Firstly, a reduction in endowment and liquidity risks by insurance and finance markets might lower the level of precautionary savings by the households, and therefore, at the end of the day, it can have an impact on the rate of growth of the economy. If country-specific endowment risks are shared via the international capital markets, savings rate and economic growth would be lower than would otherwise be the case. Thus, a reduction in these two kinds of risk as a result of financial development can have different effects on growth. Secondly, financial development, for example, by reducing financial repression could lead to increase in the interest rates paid to households, but the effect of such an interest rate hike on savings might not be necessarily favorable due to the prevalence of the well-known income and substitution effects. Empirically, however, financial repression has generally found to be growth retarding, especially in the article by Robini and Salai Martin of 1992. Thirdly, easing liquidity constraints on households by liberalizing consumer credit and mortgage markets lowers the savings rate, since younger generations in the overlapping generations model would save much more in the absence of liquidity constraints. Thus, in the endogenous growth theory, the overall effect on the savings rate is not unequivocally clear, and financial development could well at certain times reduce the savings rate via the effect on the growth rate. Lastly, we come to the concept of how best to measure the financial systems. One of the earliest attempts to quantify the size and change in the financial system was Goldsmith Financial Interrelations Ratio, which is commonly called FIR, which was also an early attempt to move from stock to flow indicators in financial measurement. Goldsmith identified three basic stages of financial development. The first consists of countries with quite low FIR, typically in Europe and North America, in the mid-18th to mid-19th century. The second group also had low FIR, but they had a much bigger role played by the government and government-owned institutions. For example, countries like Germany, or for that instance, even Russia in the late 19th century. The third group, this does not possess low FIR. Basically, they possess a very high FIR, typified by a much higher ratio of equities to debt, a higher share of financial institutions or financial assets, and a relatively decline in the share of banking institutions compared to other financial institutions. This might be described as the current Anglo-Saxon model. The FIR, that is a ratio of the market value of the flow of instruments to the total tangible wealth, did indeed confirm the long-term tendency for financial and economic growth to go in parallel, although Goldsmith remained uncertain of the direction of causality. Another early approach to financial measurement was to think about the mix of financial instruments that bridged the gap between the borrower and the lender at the optimal level of risk, return, and maturity. This involved a direct examination of the fundamentals of the financial system, like intermediation, reallocation of current savings, asset transformation, easing the transfer of ownership and control of the stock and flow of wealth, and transformation of maturities. Gurley and Shaw were early proponents of attempts to measure the flow and stock of primary and secondary financial instruments in relation to the national income. Gurley's financial ratio, which was called the ratio of total financial assets to GNP, is limited in that it compares stocks to flows. However, his results correlate with Goldsmith's findings, suggesting a relationship between the rise in per capita income and the size of the financial system. However, Gurley was also keen to stress that there were different paths for achieving growth. For example, some economists might make very minimal use of financial markets, and they may rely on the central planning and the pooling of funds, just like in the case of Russia. In such systems, the tax structure could be used to channel the funds, and he even suggests inflation as a means of affecting the generation and flow of funds. In addition, he suggests that it may even be rational for a country that has embarked on a particular course for financial development to stick with it for a prolonged period of time rather than attempt to transfer to a different development path. We would now like to focus on the factors that affected the supply of financial services. We look at two time periods. That is, at present, what are the factors that might affect the supply of financial services, and previously, what were the factors that affected. So we call it then, and we now call this period as now. So in the context of then, we have the type of economy which plays a very important role in affecting the supply of financial services, because different economies with particular biases and factor endowments tend to put different demands on their financial sectors and thus affect their structure. For example, agricultural economies might have quite limited requirements, ones heavily geared to the seasonal and erratic nature of the business, and while in an industrialized economy, maybe the nature of finance would be totally different. Then we can have the concept of the stages of development. Stage of development of a particular economy can really affect the supply of financial resources, because as the structure of growth changes, so do the needs for financial intermediation. Gershon put forth the idea that the structure of the financial system was basically a function of relative backwardness. As economies move between the phases of growth driven by, for example, agriculture, trade, or driven by trade or investment or consumption, the nature of demand for the financial services will change accordingly. So more sophisticated economies, they tend to require greater choice, such as they might want services for housing, or they might want services for insurance. Okay, so these are missing in the context of agricultural economies. Next, we have the concept of macroeconomic shocks. So then, macroeconomic shock was another very important factor that affected the supply of financial services. Now, what do I mean by this? Now, macroeconomic shocks can seriously affect an economy's fundamentals. Like bouts of severe or hyperinflation may be a very common destabilizing factor, whether it be it in Germany in 1923 or in Argentina in the 1980s or in Zimbabwe in some last few years. Wars and war financing can greatly affect financial stability, and for years afterwards they really affect the ability of the institutions to intermediate due to the constraints that has been put forth in their balance sheets. History have also shown that severe business cycles can affect the banking system's attitudes to types of financing for a prolonged period afterwards. For example, we have the scam, the Ponzi scam of Bernard Madoff, who had an impact on the public response to the latest financial crisis. Although it's harder to say what the longer term fundamental effects on regulation and financial structure could have resulted into. And other factors that really do affect the supply of financial services then were social and political influences, legal and regulatory constraints, and individuals. While at present, the factors that affect the supply of financial services are basically incentives for innovation, financial infrastructure, access to global investors, fiscal and exchange rate regimes. Lastly, we would like to focus on the indicators of financial development in the context of the Indian economy. The broad-based indicators of financial development are as follows. Number one, the contribution of finance-related activities in the real GDP. That is basically, we are looking at the contribution of banking and insurance in GDP. That is, the share of real GDP which is originating from finance-related activities. These have really experienced a steady increase from 2.2% during the first half of the 70s to around 4.7% during 1993-94 to 97-98. Within the service sector, the share of finance worked out to little over 11% during the 90s. Second comes the concept of finance ratio or FR. It is the ratio of the total financial claims to national income. This is an indicator of the rate of financial development in relation to the economic growth of the country. This ratio also exhibited a steady increase over the period under consideration and reached around 0.5 during 93-94 to 95-96. Next, the financial interrelations ratio. It is a ratio between the total issues to net domestic capital formation. This reflects the relation between the financial structure and the real asset structure of the economy. Though the ratio exhibited year-to-year fluctuations, it also averaged at around 2.4% since 1990-91. Next comes the new issue ratio. The new issue ratio is a ratio of primary issues to net domestic capital formation. On the other hand, this was high in 91-92, but it was high at around 1.618, but then it declined to 1.161 in 94-95, before again increasing to around 1.328 in 95-96. Basically, this ratio, that is a new issue ratio, is indicative of the extent of dependence of the non-financial sector on its own funds in financing the capital formation. A downward movement in this ratio, and this downward movement was witnessed in the years 92-93 to around 95-96. This basically reflected the continued role of financial intermediation also in the context of capital formation in the Indian economy. And then we have another type of measurement or indicator, which is called the liquidity and credit based indicator of financial development, and this was primarily reflected in the aggregate deposit GDP ratio, or we can also call it the M3 by GDP ratio. In particular, M3, that is a type of money supply, by GDP ratio surpassed the 50% mark during the 90s. And then we have the banking based indicators of financial development. Now, the banking system in India consists of mainly the commercial banks and the cooperative banks. But it is basically the commercial banks which is dominant in terms of deposits, advances, investments, etc. Since 1969, the commercial banks, after the nationalization of the 14 banks, have made rapid strides in all spheres of banking operation, be it in the mobilization of deposits, in the deployment of credit or geographical coverage, and they have basically accounted for most of the growth in the banking system. We also know that in the Indian economy, development financial institutions had got a very important role to play. They were established in India to resolve a typical market inadequacy problem. Namely, there was a shortage of long-term resources and the perceived risk averse of savers and creditors to part with funds for long gestation projects. So in terms of industrial finance, these development financial institutions really played a very crucial role in the context of the Indian economy. Now, as a percentage of GDP, disbursement by financial institutions basically increased from as low as 0.5% in the first half of the 70s to around 1.4% in the first half of the 80s. And this ratio increased even further to around 2.9%, a little less than 3% in the first half of the 90s, and in the second half of the 90s it stood at around 3.3%. So we find that when we look at the financial development indicators of the Indian economy, we see that India has really come a long way from the era of the 50s, the era of the first 5-year plan, and with all its problems in planning, India have really come a long way in terms of financial development. And with given the various theories of finance and growth related, we are sure that the way the Indian economy and its finances are progressing, it is surely going to lead to more and more economic growth in the near future.